Joining us now is Anton Schutz, president and founder of Mendon Capital Advisors Group. The firm manages the Burnham Financial Industries and Burnham Financial Services funds, which both ranked in the top 10% among their peers last year and for 5 years. Anton, welcome to Bloomberg News. Good to see you again.
Pleasure to be with you today.
Don't know if you got a chance to hear our interview with our Michael Moore, but he has a story on the Bloomberg terminal today, and the opening paragraph says the 4 biggest U.S. banks by assets may have to take write-downs on $55 billion of mortgage collection contracts after marking them up by $11 billion in the second quarter. Was wondering if we might get your reaction to that.
Well, I did have a chance to both read the article and listen to your last segment, and you know, mortgage servicing is always one of these interesting accounting, I don't know, you've used the word gimmick or trick or...
Dick Beauvais called it a game.
Yeah, mark-to-market is one of those things, and you know, I think to some extent mark-to-market's created more confusion and a mess out there for everybody than it's helped, because it certainly created a lot of fear last year. When you look at mortgage servicing, there are a lot of moving parts here, but the banks do hedge it, so that is part of the equation as well, and as well as the fact that, you know, if people aren't going to refi because they're so underwater, you may actually have a you know, possible extension of how long the average life of a mortgage is. So I think there's a real trade-off here in terms of what they may write down and write up. But you know, to me, that's not all that important right now to what banks are going to earn, because I'm looking at credit as being the big driver here, and that's, we're looking for more clarity on it. We're looking for loan loss reserves, and mortgage servicing to me has always been noise. You like to see what the trend is. But you know, there are a lot of offsets banks can use to take gains. I mean, if they own any government securities as an offset,
right,
boy, they got some big gains there. If they own any agency securities, which they do, they've got some big gains there, because our you know, Fed has been certainly buying a lot of those securities, driving in spreads. So you know, the banks have gains to offset these rights if they have to write them down.
So then, which factors, you mentioned a couple there, will contribute to a good quarter for the big banks, and which ones in particular fit the bill?
Well, certainly the mortgage refi business is alive and well. So aside from the servicing side, you ought to see the origination side of the businesses do quite well. And again, the biggest banks have a large concentration of the mortgage refi business. So you'll see good numbers there, whether it's JP Morgan, Wells, or Bank of America. The numbers will be pretty strong. The other thing you're going to see for the capital market-centric businesses is, you know, there have been some terrific volumes of underwritings in both bonds and equities. And those businesses are very, very strong. You know, volumes in equities are lower, but certainly the underwriting has been terrific. So the investment banking business from those line items are great. Not much advisory business yet, but you expect the underwriting to really carry the day for them.
Hey, Anton, it's Michael Moore. You mentioned the mark-to-market and the impact that has on the earnings. With so many moving parts in mark-to-market, how much do you look at the income statement versus, say, the cash flow statement? And what particular do you look at in that income report that you think is sustainable quarter to quarter?
Boy, I love your question, because it really leads me into a terrific line. You know, you realize that Citigroup cash flowed pretty much throughout all of its write-downs. So cash flow is important. I do look at it. It is important about sustainability for any business, whether it's a bank or anything else. And mark-to-market has really contributed to, you know, things getting distorted because cash isn't flowing. And obviously, when you have banks also building loan loss reserves that aren't matching, you know, charge-offs, the reserves are bigger than the charge-offs, it also leads to non-cash hit to earnings. So, you know, that's important to me. I mean, right now I'm looking for, you know, what are the loan loss reserves build? You know, what kind of charge-offs are they taking? What kind of capital actions are they taking? So a lot of these companies have raised capital, so I want to look at their capital ratios. And I also want to look at their net interest margin, because for the most part, the banks are benefiting from a very, very wide curve. I think the Fed's pretty happy about that, because it's certainly one way to recapitalize the banks. So you're seeing margin improvement across the banking industry. Deposits are certainly cheap right now for them, and when they are lending, they're getting their terms. So margins should be widening out at most financial institutions.
Anton, how big of an earnings hurdle will it be, perhaps beyond this quarter, if banks do, in fact, have to add a lot more to their reserves?
Well, I have no doubt that this quarter will continue to be an add. And I expect those that have been sort of late to the party and haven't done enough to use the fourth quarter as a kitchen sink. I do expect that you may see some companies actually stop adding to reserves. I think my first pick to that one is First Horizon, FHN. I think they could certainly be one of the first not to. JP Morgan, I think, is going to still add, but maybe not add as much. They'll certainly be an early entrant. I also expect that eventually dividends are going to get paid again. I think J.P. Morgan probably not this quarter, but maybe next will reinstate its dividend. I think that'll be terrific news.
Anton, might I ask, because you hinted at this a couple of minutes ago about credit delinquencies. What about upcoming accounting changes? How are they going to affect the credit story?
Well, there's certainly a lot of questions about upcoming accounting changes and how securitizations will be viewed as what, off-balance sheet items. And I think there's a lot of unanswered questions, but certainly a lot of fear out there. And again, when you have a banking industry that may be a little light on capital,
right.
The last thing you want to do is force more assets onto their balance sheets. So you've got the accounting industry taking on, doing the theoretical versus the practical, which is, you want these banks to survive and stay in business. And I think, we ought to address this another day and bring that on the balance sheets down the road when these companies have excess capital.
So, Anton, listening to this discussion, is it fair to say this quarter's report among the big banks may be the best for a while?
No, I think there's some good components here. I really expect you're going to start seeing much greater improvement, coming into the early to the mid of next year. These companies will actually start reporting positive earnings. I expect a couple of these companies could actually report losses. I think, Goldman and J.P. Morgan I expect to have positive numbers, and Goldman very strong. Bank of America and Citi could both report losses. And I think really the best is really coming from margin, from mortgage, from underwriting. But I think advisory business could get much better as you see more M&A out there. So that could certainly help earnings down the road. And I think, like I said, if you don't have to add to credit reserves, there's really an opportunity for all of a sudden these earnings to come out of nowhere because you're no longer over-providing. You're just matching charge-offs, maybe even eating your reserves.
Anton Schutz, president and founder of Mendon Capital Advisors Group, joining us from Rochester, New York. Anton, always good to talk to you. Thanks.
My pleasure.